Welcome to the Explainer. You know, for a lot of people, the stock market feels like a giant casino, a total gamble. But for the world's best investors, it's not like that at all. For them, it is all about having a system. And today, we are going to dive deep into that system, a blueprint you can actually use to find top stocks and, finally invest with some real confidence.
The legend himself, Warren Buffett, absolutely nailed it with this quote: "Price is what you pay, value's what you get." And that simple idea, it's the key to everything. You're not just buying some ticker symbol that wiggles around on a screen. No, you're buying a piece of a real, living, breathing business, one with actual factories and employees and, hopefully, profits. But that brings up a really big question, right?
Yeah, exactly. I mean, in a sea of literally thousands of stocks, how on earth do you cut through all the noise? The hot tips, the flashy headlines? How do you find those companies with real, lasting strength? How do you figure out what a business is actually worth?
Well, the answer lies in a huge mental shift you've got to make, from gambling to investing. See, gambling is all about gut feelings, emotions, and just plain luck. It's a bet. But investing? That's systematic. It's proactive. The pros have a repeatable process for finding opportunities and for managing their risk. They are not rolling the dice. They're making smart, calculated decisions based on actual evidence.
So how do we build that system? We're going to use a really powerful framework called the 4 pillars of investing. I want you to think of it like a sturdy table. It's got 4 legs. If even one of those legs is wobbly or missing, the whole thing is going to collapse. But when you have all 4 pillars firmly in place, that's when you have a solid, stable foundation for every single one of your investment decisions.
So here's our game plan for today. First up, we're going to look at the big picture, the overall market. Then we'll get into the what to buy with Pillar 2, fundamental analysis. After that, we'll tackle when to buy with Pillar 3, technical analysis. And finally, we're going to talk about what might just be the most important pillar of all, the one that holds it all together, managing risk and your own psychology.
All right, Pillar 1, the broad market. Before you even think about buying a single stock, you have to know what kind of weather you're sailing into. You've heard the saying, a rising tide lifts all ships, right? Well, a falling tide can sink even the sturdiest ones. Trying to invest in a great company during a nasty bear market? Well, it's like trying to swim upstream in a raging river. You might make it, but why make it so hard on yourself?
So, how do you actually check the market's pulse? Simple. You look at the major indexes. The S&P 500, that's your bird's eye view of 500 of the biggest companies in the US. The NASDAQ is super tech-heavy, so it gives you a feel for innovation and growth. The Dow's got your 30 industrial heavyweights, and the Russell 2000 tracks the smaller companies. When you look at them all together, they paint a pretty clear picture of the market's mood. The goal here is simple: swim with the current, not against it. Okay, so you've checked the weather, and the tide is in your favor. Now it's time to pick your ship, and that brings us right to Pillar 2, fundamental analysis. This is the pillar that helps you answer that huge question: what should I buy?
With this pillar, I want you to think of yourself as a detective. Seriously, you're putting a business under a microscope. You're digging through its financial statements, checking out its debt, its profit margins, the whole shebang. You're sizing up the management team and trying to figure out its competitive edge to determine what this business is truly worth. You're completely ignoring the day-to-day noise and focusing only on the long-term health of the business itself.
Now this is where it gets really interesting. Inside fundamental analysis, there are 2 main camps, 2 big schools of thought: value investing and growth investing. Now, they both look at the business, but they're looking for totally different things. Value investors, think Warren Buffett, are hunting for great companies that are on sale. Growth investors, think Peter Lynch, they're looking for the next big thing, companies with explosive potential. Let's break them both down.
First up, let's talk value investing. The philosophy here is so simple but so powerful. Find an awesome business and try to buy it for way less than it's actually worth. It's basically the investing version of finding a dollar bill on sale for 50 cents. You're always looking for that margin of safety, that cushion between the price you pay and the value you're actually getting.
The guy who literally wrote the book on this, Benjamin Graham, had this super strict checklist to find these bargain stocks. I mean, look at this. He wanted a rock-solid financial position, like a current ratio over 2. That just means the company has twice the cash to cover its short-term bills, a massive safety net. He demanded decades of profits, consistent dividends, and a dirt-cheap valuation. This was all about safety first. But then his star student, a guy you might have heard of named Warren Buffett, came along and put his own spin on it. Instead of just buying any cheap company, Buffett focused on buying great companies at a fair price. And one of his absolute favorite metrics is return on equity, or ROE. Why? Because it's like the ultimate report card for a CEO. It tells you exactly how good the management team is at taking the company's profits and turning them into even more profits. It's the sign of a true cash machine.
Okay, let's flip the coin and talk about growth investing. Now, this is a whole different ballgame. This is about finding the next big thing. We're talking about companies with game-changing products, getting in on the ground floor of the next Amazon or Apple. You can feel the excitement here, right? You're hunting for the superstars of tomorrow.
So, to find these superstars, legendary investor William O'Neill created this incredible 7-step checklist called CAN-SLIM. It's a fantastic way to turn a complex strategy into an actionable plan. For instance, the C and the A demand amazing current and annual earnings growth. The logic is simple. The best companies are already proving it with their numbers. The N looks for something new, a catalyst, like a revolutionary product that's going to send the stock soaring. L is crucial. You want the leader in the industry, not a laggard. And look at M, market direction. It brings us right back to pillar 1, making sure the tide is with us. See how it all connects?
Okay, so you've done your homework, you found a fantastic company, and the overall market looks good. Now comes the million-dollar question. When exactly do you pull the trigger and buy? Because let me tell you, a great company bought at the wrong price can be a terrible investment. And that's where pillar 3, technical analysis, comes into play.
So with this pillar, we completely switch gears. Technical analysts or technicians, they don't really care about balance sheets. They look at charts. They believe that a stock's price and how much of it is being traded, the volume, tells you everything you need to know. Why? Because it reflects the sum total of every single investor's hopes, fears, and knowledge all rolled into one. The chart literally becomes a visual story of the epic battle between buyers and sellers.
And the single most important concept in this whole world is the trend. You've probably heard the saying, the trend is your friend. And there's a reason for that. An uptrend is just a simple series of higher highs and higher lows. Each time the stock dips, buyers jump in more aggressively than the last time. It's a clear sign that the buyers, the bulls, are in total control.
And, you guessed it, the opposite is true for a downtrend. It's a series of lower highs and lower lows. Every little attempt the stock makes to rally gets smacked down by sellers. This tells you the sellers, or the bears, have the upper hand. The rule here is incredibly simple, but so powerful. Trade with the trend, not against it.
Now, to read these chart stories, technicians have a whole toolbox of cool gadgets. They use things like candlestick patterns, which are like little snapshots of market emotion. They identify support and resistance levels. Think of these as price floors and ceilings where big fights between buyers and sellers are likely to happen. They also spot bigger chart patterns and use moving averages to smooth everything out and see the real trend more clearly.
Let me show you a really cool classic pattern. It's called the kiss goodbye. So imagine a stock is bouncing off a certain price level over and over again. That's support. It's a floor. But then it breaks. It falls right through the floor. When it tries to rally back up, that old floor often becomes a new ceiling. And the psychology here is everything. All the people who bought at that old support level are now losing money. They see the stock getting back to where they bought it and they think, yes, a chance to get out without losing money. That wave of selling creates a powerful wall of resistance, confirming the bears are now in charge. All right, we've covered the market, what to buy and when to buy. But I'm going to be honest with you, none of that means a thing in the long run without this final and I believe most important pillar, managing risk and mastering your own psychology. This is where most investors crash and burn.
Look, professional investing is about survival first and profits second. You have to protect your money. That means you always have an exit plan, a stop loss, before you even get into a trade. It means using smart position sizing, because the math is brutal. If you lose 50%, you need a 100% gain just to get back to where you started. And it means you can never, ever fall in love with a stock. These aren't suggestions. They are non-negotiable rules.
This right here, this is one of the biggest secrets that separates the pros from the amateurs. It's called the reward-to-risk ratio. Before you ever make a trade, you have to ask yourself, if I'm right, how much can I win? And if I'm wrong, how much could I lose? A lot of pros won't even touch a trade unless the potential reward is at least 2 or 3 times the risk. Think about that. It gives you this incredible mathematical edge. It means you don't even have to be right most of the time to make money.
Because after all the charts, all the spreadsheets, all the analysis, the biggest threat to your financial success isn't the market. It's you. It's the person staring back at you in the mirror. Our brains are hardwired with all these biases that make us awful investors. We have fear of missing out, so we buy at the top.
We panic, so we sell at the bottom. We look for information that just confirms what we already believe. It's a minefield up there.
So what's the solution? You have to learn to detach emotionally. You have to become like a doctor, an impartial diagnostician, looking at your investments based on cold, hard facts, not your hopes or your feelings. You've got to be willing to admit when you're wrong and cut your losses fast. You have to, as they say, kill your darlings. Remember, your job isn't to be right all the time. Your job is to make money. And sometimes that means taking a small, planned loss to avoid a catastrophic one.
So there you have it, the 4 pillars of investing. It's a complete framework. We've talked about understanding the broad market, using fundamentals to find great companies, using technical analysis to time our entries, and of course, the absolutely vital importance of managing risk and your own mind.
You know, the goal here today wasn't to give you a bunch of hot stock tips. It was to teach you how to fish for yourself. This framework, it isn't some magic formula. It's a disciplined, repeatable process that you can use to analyze any stock, in any market, and to start making your own informed decisions with real confidence.
These 4 pillars, they're your foundation. Now, it's your turn to start building your own personal investment strategy on top of them. Are you going to lean more towards value or growth? Which technical tools are you going to master? The blueprint is yours. The only question left is how are you going to use it?